Yeah, so we want to look at the statement of financial position. The question was about Marula Farmers Cooperative Society. So Marula Farmers Cooperative Society, statement of financial position. Statement of financial position as at is supposed to be as at. So it is normally as at, exactly as at 31st of December 2021. 31st of December 2021. 31st of December 2021. So we can be able to indicate I don't know whether the board is clear. Hope the board is clear at your end. Is the board clear at your end? Is the board clear at your end? Admin, is the board clear at your end? So we can look at the statement of financial position for this particular cooperative society. So we can have now in this case our shillings. We can have our shillings in thousands like that. Shillings in thousands like that. So shillings in thousands like that. So we can start with the non-current assets. Non-current assets. So for assets, they likely be on the debit side of the trio balance. But in this case, you can always be able to confirm whether there were any form of what adjustment on the assets, whether there were any form of what adjustment on the assets. So for example, in this case, if you look at in this case the non-current assets, then we have investments. So if you can be able to see investment in Wakulima Bank Limited. So hope you can be able to see that one. Investment in Wakulima Bank Limited. So investments in Wakulima Bank. Investment in Wakulima Bank. It is actually an amount of 26,650. I think it's 26,650. 26,650. Still, the last item in the trio balance, you can be able to see office equipment. You can be able to see office equipment. You can be able to see office equipment. Office equipment of an amount of, in this case, it is actually 900. It is actually 900. It is actually 900. 900. So for this kind of assets, always be able to confirm whether there was actually any form of what depreciation provided. So if there was a depreciation, in this case, it means we would have been able to adjust it. But we haven't been told there was any form of what depreciation. We haven't been told there was actually what any form of what depreciation. So we won't be able to do any form of adjustments, but we'll just pick the figure the way it is. From what? From the trio balance. So you look at any other item in the trio balance that is a non-current asset. I don't think we have any other item. So they are only the two. So you can be able to add the two. You can actually be able to add the two to get the total value of, in this case, what? Non-current assets. To get the total value of non-current assets. Non-current assets. So in this case, it is a value of 27,450. 27,450. So we can go to the current assets that we have. We can go to the current assets. The current assets that we have. We can go to the current assets that we have. And most obviously, we've already been able to say the assets. So investment is exactly what? 26,550. Not 650, 26,550. 26,550 years. Thank you for the correction. 26,550. So 26,550. 26,550. So then you add equipment. You think you should be able to get 27,450. 27,450. So the current assets, the assets will likely be on the debit side. And of course, now in this case, the assets you are having here that you can be able to see there. We have in this case, what? So you have loans to members. So you have in this case loans to members. loans to members. You have in this case loans to members. So loans to members. Loans to members. We have the loans to members, which was an amount of 972,340. 972,340. 972,340. We have in this case accounts receivables. So receivables. We have the receivables. Receivables. This one you can be able to see them in the trial balance. We have receivables regarding members and non-members. So members, and of course what non-members. Members and of course what non-members. So you can be able to see an amount of 2690, 2690, 2690. This one is in the trial balance. Also, this one is in the trial balance. Loans to members is actually in the trial balance. You can be able to see it. You can be able to see it. So it is there. Loans to members, 972,340. Then receivables to members and non-members. They are the second last items in the trial balance. So it is 2690 and of course 22,500. 22,500. So those are part of what the assets there. Then we have there were some savings in the bank. So Wakulima Bank savings. So Wakulima Bank limited savings. So there's some money in the bank there. So Wakulima Bank savings. Then of course in this case also we have the cash in hand. So Wakulima Bank savings and cash in hand. So Wakulima Bank savings. And of course also we have the cash in hand. Cash in hand, still in the trial balance, you can be able to see it. Cash in hand is an amount of 540. 540 from the trial balance. So 540 from the trial balance. Wakulima Bank savings is 6780. 6780 is actually an amount of 6780. So those are part of the assets that you can be able to get in the trial balance. The assets you can be able to get in the trial balance. Then of course, now in this case, you've actually been told, if you look at additional information number one. So we are told that in this case, Bora Limited markets Safi and Mzuri brands for Marula Society. On 31st of December, Bora Limited sold Safi and Mzuri brands for 175,000. That is what in dollars, and of course 115,300 in dollars. Bora Limited remitted the above amounts to Marula the coming year. So it means by the end of this particular year, they remitted the amounts. They remitted the amounts on, is it 15th of January 2022. So it means on this particular date, those amounts were actually what? Receivables. They were actually receivables. So they sold for them coffee on behalf of the cooperative society. And the monies were paid to the COP society the coming year. It means the monies sold regarding this particular coffee here, by 31st of December 2021, they were actually what? Accounts. They were debtors. They were actually what? Debtors. They were actually debtors. So there are these amounts which were yet to be received by the end of the year. We'll still actually be able to recognize them as part of what? The receivables. Part of what? The receivables of this particular what? Cooperative society, because they were not actually paid in the year 2021. They were actually paid January the coming year. So by the end of this particular year here, 31st of December, they were having to be accounted for as what? As part of what? The receivables. And therefore, in this case, the receivables end up having to be part of what? The assets of the company. Assets of the company. So we can be able to account for this. So unpaid coffee. So in this case, unpaid amounts regarding coffee. So the unpaid amounts regarding coffee. So unpaid amounts on coffee. So unpaid coffee amounts, unpaid coffee. And of course, in this case, we can be able to add them. So we can be able to add them. So the sales in this case that had actually been realized, the sales that had actually been realized, there was actually 17,500 and 11,530. So 17,500 and 11,530. 17,500 plus 11,530. So remember, there were two brands. So they sold them on behalf of the COP society. but by 31st, they had not paid. They paid 15 days later. On this particular date, we are preparing the statement of financial position. They were accounted for as monies to be expected to be received, which were receivables from their marketing company. And therefore, in this case, we should actually be able to add them and recognize them as outstanding amounts in terms of what receivables expected to be received by this particular company. So if you add the two, it comes to how much? So 17,500 plus 11,530. So 11, that is 28, 29, I think 29,030. 29,030, 29,030, 29,030, 29,030. So those are the amounts in terms of what? Those are the amounts in terms of the unpaid coffee, which you'll be able to recognize as what? As receivables. So you can be able to add, and what is the figure you're having to get? Because those are the only assets that in this case will be there. So what are the figures you're having to get when you add these ones? 972, 2690, 22,500, 6780, 540, 29,030. 29,030. Do we convert to Kenyan shillings? We already converted. So Edwin, remember in this case, we prepared, in our previous class, we had already prepared and we converted. Tulikuwa tumeconvert. So Ateka, do you remember we converted Ateka? When we are preparing in this case, the marketing sales, the sales that were realized here in that account for Mzuri and of course Safi. You remember that account? You remember that account? You had already converted. So are you able to see it Ateka? So I can see Irene says 1033, 880. 1033, 880. I want you to confirm whether you are seeing these figures in those two accounts that we had already prepared as the cells. Are you seeing them? Anyone having to see them, Karen Paul, are you seeing these figures as the cells? Yes, the figures are there. Daniel, you can be able to see them. So we've just brought them here because I've already been able to explain those cells were not paid by 31st of December 2021 when we are preparing what? This statement of financial position. So they were paid 15 days later. So it means by this data, these were debtors. These were amounts having to be anticipated to be received. When you make sales on credit, in this case, they give rise to what? Debtors or accounts, what? Receivables. So therefore, we should be able to recognize them here. You should be able to recognize them here. So sawa sawa. So sawa sawa, sawa sawa, sawa sawa. So I can see you're saying 1033. Is it 880 or 8? 1033, 880. You said 1033, 880. So I can see you are saying, but this one is as per what? As per 31st. 31st of 31st of December. You're saying as of 31st of December. Is as of 31st of December. So, but now in this case, you know the amounts that will end up having to be received. It is not the ones that in this case are actually at the rate of what? They're not the amounts that in this case they're actually at the rate of 105. They receive these monies in the account. When they receive the monies in the account on 15th of this particular date here, because that's when in this case the monies will likely be paid. So they'll basically in this case end up having to realize in this case how much? At 100 shillings. At 100 shillings. So that is the money they'll end up having to receive. Because in this case, if you account for them here at 105, but at the end of it all, they'll end up having to receive what? A lesser amount. So we'll be able to account for them with the amount in this case they'll end up having to convert, which in this case will be what? At 100 shillings. At 100 shillings. So we'll take these accounts receivables as 17,500 plus 11,530. So I think in this case you'll be able to get 29,030, 29,030. So I think you've added, I can see you've given me some figures there. 103, 1,033,880. I think that is the figure you're having to get. So 1,033,880. 1,033,880. 1,033,880. So we can now in this case look at the side of equity and liabilities. So equity and liabilities, equity and liabilities, equity and liabilities, equity and liabilities. So equity and liabilities. So what do you get when you add the two? You can be able to add so that we get the figure here. When you add the two, so 1033,880 plus 27,450, you can add the two, 27,450 plus 1033,840. You are getting how much? So 10, you're getting 1061,330. So 1061,330. So 1061,330. 1061,330. Then we can look at the side of equity and liabilities. So under equity and liabilities, we had already computed the two figures. But we can start with the share capital. So we can start with the share capital. So share capital. We can start with share capital. So the share capital in the TO balance, we can look at the share capital in the TO balance. Share capital in the TO balance is an amount of how much? Share capital in the TO balance is an amount of 900,000. An amount of 900,000. So this one is, we have shillings in thousands. So this one is 900,000. Then remember, you had already computed two figures. So in this case, we had the statutory reserves, and also we had, in this case, computed the revenue reserves. So what was our figure for statutory reserve? What was our figure for statutory reserves? 16,578. So 16,578. What about the figure for revenue reserves? The one we computed previously. We had a working. Just before this particular balance sheet, there's a working we did. It was the figure for revenue reserves. It was how much? So statutory reserves is 16,578. What about in this case, revenue reserves? Or we didn't do it? It was 17,402. So it was 17,402, 17,402, 17,402. So hope everyone has these particular two figures here because we computed them in our previous class. We had actually computed them in our previous class as workings. So we just plugged them here. And of course, they were having to be affected by, if you look at additional information number 6, they're saying as per the relevant ministry regulations, cooperative societies are required to transfer 20% of their net earnings to statutory reserves. So in this case, if you look at the TO balance statutory reserve fund, is actually 13,740. But now we need to take 20% of what we got as the retained earnings in the income statement. And we did the working. In this case, we got how much? 16,578. 16,578. So then in this case, what will end up having to remain there will actually go to what? To the revenue reserves, which is actually 80%, So another component of, in this case, equity, we said, we can also be able to put what we call members' deposits. So members' deposits is an amount of, from the TO balance. So the members' deposits in amount of 64, I think 64,650, 64,650, 64,650. So that is members' deposits. So you look at still at the TO balance, there's what we call revaluation reserves. There's a revaluation reserve of, I think, 750. Revaluation reserve of 750. 750. So you can always confirm whether there's any other item of equity that you haven't included. So in this case, always the items of equity will likely be on the credit side. So you need credit side of the trio balance. You have to go there and actually look at any item that you feel like in this case is an item of equity, that in this case we haven't been able to do what account for it. And of course, I think we've been able to account for all of them. So we have accounted for all of them. So that is basically what will likely be the component of the equity part of the cooperative society. So we can now in this case go to any non-current liability that might end up having to be there. Any non-current liability that might end up having to be there. So we can be able to confirm whether we have any non-current liability that might end up having to be there. Liabilities will likely be on the credit side. Will likely be on the credit side. So we are told there is interest on loans to members. That was an item of income. So I don't think there's any item. So we can just in this case be able to mention the liabilities. So the liabilities, no item specifically in this case having to go to what to the non-current liabilities. So, but you have in this case what a number of liabilities there. So we have in this case audit fee. So remember in this case under note number 3, audit fee provided for 600. So you have in this case audit fee. Audit fee. And I told you if they say it was provided for, they did not actually pay for it. So it is still actually what outstanding. It is still actually what outstanding. So in this case, you have an amount of 600,000 that is still outstanding in terms of the audit fee. So that is a liability. Then we have staff salaries. So staff salaries, not number 4, staff salaries and wages amounting to 3.2 had not been paid. So staff salaries outstanding. So staff salaries, accrued salaries. So that is an amount of, is it 3.2 million? 3 million, 3.2 million is how much? 3.2 million is an amount of, yes, 3.2 million. So 3.2 million. So this one is actually, this audit fee is actually 6 million. It's actually 6 million. Yes, it is 6 million. So we can be able to correct. This one is 6 million. So this one is 6 million. This one is 3.2 million. So this one was outstanding. And we said in this case, accrued expenses will likely be what? Be liabilities. Then we have in this case, interest to members. So we are told there's some interest to members which was yet to be paid. So interest to, not number 5, interest to members deposits is to be provided at 60.86. So interest to members which is yet to be paid, interest to members which is actually 60.86. 60.86. So that is these are basically in the additional information. So if this audit fee is under additional information number 4, this one is under additional information number 5, this one is under information number 6. So all these particular expenses were just provided for, but they were yet to pay for them. So it means by the end of the year, they were still outstanding to be paid by this cooperative society. So they were liabilities. So we can be able to look at now, in this case, the TIO balance, and of course, we can be able to identify any other form of what liabilities that might be there. So if you look at the TIO balance, and of course, obviously, they'll be on the credit side. You have accrued rent, which is the second item. So accrued rent, we have accrued rent. We have accrued rent, an amount of 49.50, an amount of 49.50, an amount of 49.50. So hope you can be able to see there. So we can adjust the camera a bit. Let's adjust the camera a bit. We have in this case accrued rent. So that one is from the TIO balance. It is the second item in the TIO balance. You can be able to see it, 49.50. Then we have in this case sundry provisions. We have sundry provisions of an amount of 89.30. So sundry provisions of an amount of 89.30. Of an amount of 89.30. Of an amount of 89.30. Then we have in this case we have creditors. So Creditors, sundry creditors, an amount of 3410. Sundry creditors and a bank overdraft. So sundry creditors, and of course also a bank overdrafts. Bank overdrafts. So bank overdrafts, it means they withdrew excess money from the bank. So that is a liability. So sundry, in this case, sundry creditors is 3410, exactly 3410. 3410. Then bank overdraft. So bank overdraft is an amount of 6150. I think that one is exactly also in the TRIO balance. Bank overdraft is an amount of 6150, yes. An amount of 6150. Then we have the very final item, the very final item. So in this case, there were some payments, which now in this case were supposed to be paid to, in this case, what? The members, to be paid to the members. Remember when they made the sales, for the coffee, so they were retaining 20%, and of course 80% was having to go to what? To the members. Was having to go to the members. Was actually having to go to what? To the members. Was having to go to the members. So it means these monies, they must actually be able to pay what? The members. But we haven't yet, in this case, been told whether they actually paid their amounts or not. It means in this case, they were still actually having to do what? Outstand. So they must actually be able to settle these 80%. So these 80% of the profits, 80% of the profits, or 8% of the sales that were actually made for the coffee were supposed to be paid to the members. And of course, in this case, for Musafi, it was how much? For Musafi, the 80% for Musafi was an amount of how much? You can look at, in this case, what we prepared as a P&L account for Musafi, for Safi and Muzuri. For Musafi and Muzuri. So for Musafi, it was how much? It was an amount of how much? I can see for Musafi, it was 14 million. And for Muzuri, it was how much? For Muzuri, it was how much? Faith, where are you getting 1100? So 1100 in this case is what they retained for operations. But now in this case, you are looking at the figure they were supposed to have paid the members. These are monies they are simply having to hold, which is not theirs. They are supposed to pay what? The members. So it was, in this case, amounts of 14 million and 9,224,000. So it means you have to add the two. So in this case, you'll add the 14 million plus 9,224,000. So what do you get? You get, I think, 23. It is 23,224. I think it is 23,224. 23,224. 23,224. So you can be able to add here another item. You can be able to, just after this one, after this bank overdraft here, you can add another item. So payments due to members. You can be able to label that item. Payments due to members. Just after this one here, write payments due to members, payments due to members. Then maybe you can put in bracket these particular two figures, 14 million plus 9224. Then you place there a figure of 23,224. 23,224. You place there a figure of 23,224. So I think that is it. Then you can actually be able to try and actually add from the top up to the bottom there. So add all these ones. So the part of equity and liabilities, add all of them, plus this final item here, 23,224. And you try to give us the figure we see. You can now add them. So add them, all of them. So from here, going downwards, then you try to give us the figure we see. I can see Joseph says 1061, 330. Another person can be able to confirm that particular figure. Another person can be able to confirm that particular figure. 1061,330. Current poll, is that what you're having to get? So 1061,330. So 1061,330. So that is what you're supposed to should be able to get here. And of course, it should be able to balance with this one. 1061,330. Sawa. So I can be able to see our friend is having to ask, what about retained earnings? What about what? Retained earnings. Retained earnings, we had accounted for it in these workings. Sawa. So I don't know whether in this case our friend Derek, were you in the previous class when we were doing these workings? Remember our retained earnings, in this case, we got a figure of, was it 14,190? Is it 14,190 or how much was it? It was 14,190. And therefore, in this case, we accounted for them in these particular two computations here. Sawa. Derek, were you in class in the previous class or you are not there? You need to be able to confirm. So you remember, current poll, you remember we accounted for them here. So that 14,190 in the profit and loss account, in the income statement, we accounted for it here. We split 20% here and I think 80% here. So we added so that we could be able to get these figures. We've already accounted for it under the part of what? Equity. We've already accounted for it under the part of equity. Derek, are you getting the point? You know, you need to respond so that we know whether we are together. Derek is not having to respond, so I don't know whether we are together or not. So, but I'm assuming we are together. So that is how, in this case, you likely end up having to come up with what? The statement of financial position. Statement of financial position. So you just need to, for example, take note of special items like loans to members is an asset. You need, for example, take note of, like in this case, what? Members' deposits is part of equity. Members' deposits is part of equity. Of course, these other ones, when you hear about the reserves, most obviously you should be able to know this is an item that will end up having to fall under what? Equity. That will end up having to fall under equity. But then you just need to know how, in this case, you account for other items like accruals or maybe prepayments. Accruals or maybe in this case, what? Prepayments. Then any other form of asset will likely basically be categorized as the way it's actually supposed to be categorized under what? The statement of financial position. Statement of financial position. So that is how, in this case, you'll end up having to do what? Prepare this particular one here. So I want us, in this case, we look at that question of medical practitioners. And of course, I had actually shared it on the group. So since you people requested we look at it, we can just look at it before we start looking at retirement benefits. Retirement benefits. So you can confirm whether you have the question. So do you have the question? I shared it today on the group. So just confirm whether you have the question so that we can be able to begin. So medical practice, that question about medical practice. I can see Anthony says yes. So the question says, on January 2018, two doctors, Sharon and Will Kister, entered into a partnership to run a medical practice. They each contributed initial capital of 2 million and were to share profits and losses equally. The following is a summary of the receipt and payment account for the medical practice for the year ended 31st of December 2018. So they have a receipt and payment account there, which has the side of receipts. Please share. I just joined. So I don't know whether there's someone who can be able to reshare on the group. So kindly, if there's anyone who can be able to manage or access it and reshare on the group, it will be far much better for our friend who has just joined. So the receipts here, on the side of the receipts, most obviously we are talking about what? Incomes. So for example, when they talk about fees from services rendered, that is an income. So loan from the bank, that is a loan. It will likely end up having to be what? To be a liability. but of course it was a 10% loan. So that 10% should actually be interest that in this case is supposed to be accounted for in the income statement. Capital contribution. So these are basically equity items, what they contributed as capital. Bank interest, so that is in this case what? An expense. Cash at bank, so this is an asset. Cash at bank is normally an asset, which basically comprises of those items that have actually been listed there. On the side of payment, we have rent, that is an expense. Salaries, an expense. Subscription to medical society, that is an expense. Medical books. So what did we say about books? How do we treat books? What did we say about books? How do we treat books? As what? As non-current assets. So you people are very brilliant. You can be able to remember. So I told you for professional firms, sometimes they can have books. So there's normally a special treatment about the books they have. They end up having to be recognized under part of what? The non-current assets. So X-ray and other equipments, those are basically assets. Medicines, and in this case, what? Consumables. So those are part of what in this case we call what? Inventory or assets. Repairs and maintenance, that is an expense. Office furniture is an asset. Drawings. So drawings will likely end up having to affect what? The capital. When they talk about drawings here, these were monies that were actually drawn by these doctors from the business for personal use. So that ends up having to, in this case, do what? Affect what will be in the business as what? As capital. So we have in this case additional information. We have in this case additional information. So additional information number one, the medical practice expected to receive 600,000 from insurance compensation for medical services done what? Rendered. So that is like part of what? An income. So salaries of medical assistants included 700,000 paid in advance, while repairs and maintenance costs, 60,000 had not actually been paid. So these are what we call what? Prepayments and accruals. Prepayments and what we call what? Accruals. Prepayments and what we call what? Accruals. Maybe I can be able to ask. In this case, they're talking about salaries of medical assistants included 700,000 paid in advance. Paid in advance. So will this one end up having to be an asset or a liability? Will it end up having to be an asset or a liability? That's 700,000. Prepayments are always what? Assets. At least you people. Then in this case, accruals are always what? Liabilities. So prepayments in this case will end up having to be always in this case be what? Be assets. This one will end up having to always in this case be what? Be liabilities. Current liabilities and current what? Assets. But remember that special treatment we said should actually be considered whenever in this case you are getting the expense, the real expense. The real expense what? In the income statement, which you are going to see. The rent had been paid for the period of 15 months up to 31st of March 2019. So they had paid rent in excess. They'd actually paid rent in excess. So it means there was a portion of this rent that was actually in this case what? A prepayment. That was actually a prepayment, which will be able to do the computation. Depreciation on assets was to be provided. So that is most obviously going to the expenses. As at 31st of December 2018, creditors for medicines and consumables amounted to 1.5 million, while 100,000 worth of medicine was still in stock. So that is closing stock or closing inventory. And of course, in this case, this 1.5 is actually what? Creditors, which will be able to account for them, in the what? In the statement of financial position. In the statement of financial position. In the statement of financial position. So that is what will likely end up having to happen. That is what will likely end up having to happen. So then interest on bank loan is still owed, is still actually owed us at 31st of December. So there's that interest that is in the TRIO balance, that is in the payments and receipts account, that of 10%. It means they had to pay for it. It will likely be what? Be a liability. So required an income statement for the year ended 31st of December 2018. Then, of course, our balance sheet as at 31st of December 2018. So we can, in this case, look at, first of all, in this case, what? The income statement. The income statement. We can, first of all, in this case, look at the income statement. The income statement. So you have, in this case, Sharon and Wilkister. Hope you're able to see there. Or you people are not able to see there. Sharon and Wilkister. Sharon and Wilkista. Yeah, Sharon and Wilkista. Sharon and Wilkista. Sharon and Wilkista. Income statements. For year ended 31st of December 2018. 31st of December 2018. So we can have, in this case, our shillings to be in thousands. We can have our shillings to be in thousands. So most obviously, in this case, in an income statement, you'll start with the incomes. You'll start with the incomes. You'll start with the incomes. You'll likely start with the incomes. So to identify the incomes, you need to go to the receipts and payment account and identify on the debit side the monies that are having to be received. Part of those items, are they actually really, in this case, what may be incomes? Are they actually maybe incomes? For example, if you look at the first item there, is fees from what? Services rendered. So they are doctors. When they render services, they get an income. So fees for services rendered is an income. Fees for services rendered. Fees for services rendered is actually what? An income, which is the first item in the receipts and payments account. So in this case, that is an amount of 17,460. 17,460. So we can, in this case, look at any other income. So we have, in this case, loan from the bank. So that is 10%. We have, in this case, capital contribution. That is a capital equity item. We have bank interest, which was actually debited in this account. So that means they'd put money in a fixed deposit account. Then they received that interest of 20%, 20. So that bank interest is an income. Bank interest is an amount of, in this case, how much? 20. So what of, in this case, maybe I could be able to ask, what of, in this case, if this bank interest was on the credit side, what would it have been? What of, in this case, if this bank interest was on the credit side of the receipts and payments account, what could it have been here? It would have been an expense. So hope you are getting the logic or what I'm trying to drive home. This bank interest was received as a receipt. It was not going out. So it means, in this case, that was what an income they realized. Then in this case, under additional information number 1, so there's no any other item of income, but under additional information number 1, the medical practice expected to receive 600,000 from insurance compensation for medical services rendered. You know, when, in this case, doctors render services, sometimes they render them, the patients come with what? An insurance card, an insurance card, like NHIF. So they provide the services, but of course they claim from the insurance. If it is NHIF, nowadays it is SHA. If it is SHA, SHA will end up having to pay them. If it is Jubilee, Jubilee will end up having to pay them. So they received 600,000 from insurance companies because they had provided services for their clients. So in this case, it means that was actually what? An income. So in this case, this particular amount expected, so income receivable from insurance. So income receivable from insurance, income from insurance. It was an amount of 600,000. It was an amount of 600,000. 600,000. And of course, those are, I think, the items of income that, in this case, they're having to anticipate. So in this case, we can actually be able to look at the expenses. We can look at the expenses. So the expenses, quite obviously, they'll be on the credit side or on the payment side of this particular receipts and payment account. So the first item you can be able to see there, it is rent. It is rent. It is rent. But there's something we've actually been told about rent in note number 3. Rent had been paid for the period of 15 months up to 31st of March 2019. So this rent, they had actually paid this one of 1,200. It was for 15 months. So it means for us to be able to determine the rent, of 2018, you have to do a computation there. So it was actually in this case 1.2 million. But now what do we multiply with for us to be able to apportion? What do we multiply with for us to be able to apportion? What do we multiply with it for us to be able to apportion? Ateka, try to think. What do we multiply with for us to be able to apportion? Anthony, try to think, try to think. So this particular rent they had actually paid was for 15 months. But now in this case, we only want an expense for this current year, which is 12 months. So in this case, we'll be able to take what? We'll multiply by, in this case, what? Faith is saying 15 out of 12. Kim is saying 12 out of 15. It is 12 out of 15. So we'll be able to multiply by 12 out of 15. So in simple terms, we're having to say that in this case, for 15 months, they had actually paid, in this case, how much? 1.2 million. What about for 12 months, the month for the year? You normally do what we call what? Cross multiplication. You remember what you're having to be told. You do cross multiplication. So you take 12, multiply by this, you divide by so what are you having to get? What are you having to get when you do the multiplication? Ateka, what are you having to get? 960. So 960, 960. But of course, you can actually be able to take note. You can actually be able to take note. Around in this case, it will be a working or something besides. It will be a working besides. A working besides. You can actually be able to take note. A working besides. A working. You can be able to put a working. So in this case, rent for the year. Rent for the year. Rent for the year in this case is actually 1.2 million. We multiply by 12 out of 15, which are getting what? 960. But in this case, we have what? Prepaid rent. Prepaid rent. Prepaid rent in this case, it will actually be 1.2 million you minus 960, which comes to how much? 240. So 240. So when we're coming up with the statement of financial opinion, we have to be able to remember this one, 240. It will actually end up having to be part of the prepayments, which are in this case what? The current assets. So you can put it as a working so that you can be able to remember that 240 is a prepayment in terms of rent, which is supposed to be part of the current assets. So hope you're having to understand that one. So then in this case, we have what? Salaries. So salaries of medical assistants included 700,000 paid in advance. So in this case, we have in this case salaries. Salaries was 3 million. So salaries in this case was actually 3 million. But you have an amount that was paid in advance. When they pay in advance, if it is not in arrears, you minus. You minus. So if it is an advance, you minus. If it is accrued, you add. If it is outstanding at the end, you add. If it is an advance at the end, you less. In this case, it means for this one, it was 2.1. But this particular one, you have to remember, still, it will be part of what? The prepayments there. Then you have, in this case, maintenance cost of 60,000 had not been paid. What is the maintenance cost we have in this case in the receipts and payment? Subscriptions, we have repairs and maintenance of 300. So repairs and actually what? Maintenance. So repairs and maintenance. Repairs and maintenance. So for repairs and maintenance, what was actually paid in this case is 300, but there was still some amount which was outstanding, which was of an amount of 60. It was accrued. For accruals, we add. For prepayments, we less. Prepayments by the end of the year, we less. Accruals by the end of the year, we add. Accruals simply means outstanding by the end of the year. So that was now totaling to 360. But now this one will likely be what? To be a current liability. It will be a current liability. So any other expense in this case, we can be able to look at the subscription to medical society. So you have in this case, subscription to medical society, subscription to medical society. It was an amount of 400. That one doesn't have any form of adjustments. You just pick it directly the way it is from the receipts and payments. Subscription to medical society. Then in this case, we have so you have medicine and consumables. So medicine and consumables was an amount of 3 million. Medicine and consumables was an amount of 3 million. But now in this case, if you look at the additional information, so as at 31st of December, creditors for medicines and consumables amounted to 1.5 million, while 100 worth of medicine was still what in stock. So for medicines and actually consumables used, so medicines and consumables used, so medicines and consumables, medicines and consumables. So for medicines and consumables, you are told that in this case, if you look at now in this case, the receipts and payment, so the medicine and the consumables, it was 3 million. But now as per note number 5, by the end of the year, the amount outstanding for these medicines and consumables was actually an amount of 1.5 million. So it means in this case, we'll be able to take the 3 million, we add the outstanding amount, which was actually 1.5 million. Then we are told that in this case, while 100,000 worth of medicine was still actually what? In stock, was actually still in stock. So it means in this case, we'll end up having to deduct this one, which is actually 100. I think you'll be able to get an amount of, in this case, 4,400,000. 4,400,000. Then you have in this case depreciation. So there's another expense of depreciation. Depreciation, there are 3 items. So we have in this case medical books, X-ray and other equipments. We have office furnitures. Furnitures. So we can be able to continue here. Let's just continue here. So the next item there will actually be depreciation. So you can do depreciation. So depreciation. So we have in this case, for depreciation, we have in this case medical books. Medical books. So that is the first item. We have in this case X-ray and equipments. X-ray and equipments. Then in this case, we have office furnitures. Office furniture. So for medical books, it is 5%. 5% of the medical books that we have there. Medical books is an amount of 1.2 million. So medical books is 5% of multiplied by 1.2 million. So this figure is actually in the receipts and payments. Then the X-ray equipments, it is 20%, 20% off. 20% off. So the X-ray equipment was 4 million. 20% of 4 million. 20% of 4 million. Then for office furniture, it is at 25% at cost, 25% per annum at cost. So for office furnitures in this case, it is an amount of 600,000 as per the receipts and payment, as what was actually paid for these ones. So you can be able to do the computation so that in this case, you can be able to get the depreciation. So this one, I think it is it 60? Is it 60 or what? So this one is 60. So you have our shillings in thousands. This one, I think it is 60 or 600. So this one is 60. This one is 800. 800. This one is 150. 150. So hope my figures are correct. So 5% of 1,200, I think it is 60. 20% of 4,000 is 800. 25% of 600, that is a quarter of 600 is 150. It is 150. Then the last item, so the last item in this case, or the last item, there's a loan from the bank of 5 million. So loan interest. It is the second item under receipts. You can be able to see it under receipts. They received a loan. So that loan was accruing 10% interest per annum. So multiply by 5 million. So that is an amount of what? 50,000. 50,000. And of course, you can be able to less these items. These are basically expenditures. You can actually be able to less them. You less them. And of course, you'll be able to get the profit realized. So profit realized, you can be able to get the profit. realized, profit realized. So you can do the computations. What is the figure here when you add the incomes? What is the figure there when you add the incomes? What is the figure there when you add the incomes? So first of all, give me the figure for the incomes. 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 So Collins, this question is not in the past papers. I shared it on the group. So it is not in the past papers. I shared it on the group. I can see you're saying 1808. So remember I told you this one has never been tested. It has never been tested. So, but is a part of professional firms, and you people had requested we do it. So I wanted to avoid it, to ignore it, but you insisted we do it. So we are doing it. So this one is 1808. 1808. Then you can minus the expenses. When you minus the expenses, what do you get? A taker. When you minus the expenses, you can minus all of them from this one so that you can be able to know the profit. We can be able to know the profit. So this one is 500 and not 50. This one is 500. So 10% of this is 500. 10% of 5,000 or 5 million is 500,000. 500,000. I can see you're saying 8150. So 8150. Then of course you've been told that these people, they share what profits equally. So they share their profit equally. So sharing of profits is actually equally. So that's what you've been told there. And what to share profit and losses equally. So in this case, it means for Sharon, she will take home in this case what I have of 8150. And of course, in this case for Will Kister, still the same case, Will Kister. She'll be able to take home in this case a half of 8150. A half of 8150. So that is in this case 4075 and 4075. 4075 and 4075. That is why in this case the profit will likely end up having to be distributed. So 4075, 4075, and that's why in this case the profit will likely end up having to do what, to be distributed. So that is what will end up having to happen there. So 4075, 4075, they'll share equally. So that is why in this case majorly doctors will end up having to operate. So maybe in this case they can set up like a partnership, or they can set up a firm to operate as partners. So of course that is maybe their part-time job. So they can set up a clinic or something. So and they could end up having to contribute resources. Then when the clinic realizes profits, they share amongst themselves. So that's what will end up having to happen. So you can now in this case look at the statement of financial position. The statement of financial position. Statement of financial financial position. But 1st of December 2018. So we can start with non-current assets. Non-current assets, we have in this case medical books. Medical books. We have in this case X-ray equipments. X-ray equipments. X-ray equipments. Then in this case we have office furniture. We have office furniture. So for medical books, of course, there was a depreciation. So we have to less that depreciation. So minus 60. For office equipment, still the same case, there was a depreciation. So in this case, it was 4 million, but now it lost value of 800 by the end of the year. Then in this case, you have office furnitures. They were 600, but they lost value of 150. Value of 150. So in this case, we'll get the net book values. We can get the net book values. So in this case, this one is actually 1140. 1140. This one is 3200. This one is 450. So this is depreciation. So we are getting the net book values. So this was their cost, but of course they lost value in terms of depreciation. So we need to get their net book values to be able to report in the statement of what financial position. So I think those are the only non-current assets. Then in this case, you have the current assets. Current assets. Current assets. Current assets. So for the current assets, if you look at the receipts and payments, there's an item there they have been able to indicate cash at bank. So cash at bank. There's an item there they have been able to indicate cash at bank. Cash at bank. So the cash at bank was an amount of 7980. Was an amount of 7980. An amount of 7980. There's of course now in this case the closing stock or inventory for consumables. The closing stock for consumables. It is in additional information number 5. So inventory consumables. Consumables are basically those items they use. For example, in this case, if you are in this case, a dentist. So there are those materials or items, for example, used to refill the teeth for the patients. There are those, for example, blades that you use. So some of them you get them, you dispose them. So like that. So they still have like those consumables of an amount of inventory in terms of consumables. Inventory for consumables. Inventory for consumables. It is in note number 5. It is in note number 5. It is in note number 5. While 100,000 worth of medicine was actually still in stock. So that is in this case 100,000. 100,000. Then in this case, as per note number 1, the medical practice expected to receive. So those were receivables from insurance. Receivables. This one is from what? Insurance companies. Insurance companies. So they were anticipating in this case to get 600,000. So that was a receivable. So that was what a receivable. It will be part of the current assets. Then you also have what? Prepayments. 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 So the first one is actually rent, which you computed there. You remember that figure there? It was an amount of 240. Or you can just be able to do it here briefly. 1200 minus 960 is giving us an amount of 240. There's another prepayment, in this case in terms of salaries. Remember under note number 2, salaries of medical assistants included 700,000 paid in advance. So of course prepayments, so in this case salaries of 700,000. So that is what a prepayment, and of course it becomes part of what? The current assets. It becomes part of the current assets. So those are the only items in this case we have in terms of what? We have in terms of the non-current assets and of course what? Current assets. So we can go to the side of capital and liabilities. The side of capital and liabilities. So hope you can be able to see here. So capital and liabilities. Capital and liabilities. So of course it will likely be in shillings of thousands. Remember, you just need to continue with the table. So you don't have to put it aside like this. Me, I'm just having to do it because my board is so squeezed. My board is so squeezed. So for you, you continue. After getting the total here, which will be able to give me the figure, you need to continue the other side of the statement of financial position. So we'll start with the capital. So for capital here, we have capital that was actually contributed by Sharon. And of course, you have what? Will Kister. Will Kister. So for Sharon, if you look at the receipt and payment, you've actually been told that in this case, she paid how much? 2 million. So capital contribution, it was actually an amount of 2 million. 2 million. 2 million. 2 million was an amount of how much? 2 million. But remember, they realized what? A profit. There was a retained earning, or there was a profit which they actually shared amongst what? Themselves. So to Sharon, in this case, she was having to receive 40.75. But remember, they made some drawings from the business. They made some drawings from the business, and that is under payments. So for Sharon, she made drawings of 3,200, which was reducing what? The capital. Remember, what went to him as a profit was increasing the capital. So if he never drew it, it will basically increase what? The capital. So we normally include retained earnings as part of equity. So you know that as part of capital. When you have retained earnings, the business becomes part of what? Capital. So for Sharon, she had contributed 2 million already. But now when they realized profit, which was actually shared equally, she got 40.75. So that is part of still, but basically what? Capital. But she had made some drawings, which normally do what? Reduce the capital. And of course, in this case, also for Wilkista, she had actually put in 2 million. There was 40.75. And there were some drawings of an amount of, in this case, 1,600. 1,600. And of course, that will actually end up having to be the portions of capital they would have done what? Contributed. So in this case, you should be able to get 28.75 here. And of course, here you should be able to get 44.75. 44.75. So that is their capital. Then in this case, you have non-current liabilities. Non-current liabilities. Non-current liabilities. So this one, there is the bank loan. There's the bank loan, which was of an amount of 5 million. There's the bank loan, which was of an amount of 5 million. An amount of 5 million. And then in this case, we have the current liabilities. Current liabilities. So for the current liabilities, in this case, you have what? The accruals. Accruals. You have the accruals. Accruals. So in terms of accruals, there is the repairs and the maintenance. If you look at note number 2, maintenance cost of 60,000 had not been paid. So part of the accruals we have in this case, what? Maintenance. Maintenance of 60,000. 60,000. Then of course, another accrual here is actually what? Loan interest. Is actually loan interest of an amount of 500,000. So it is yet to be paid by the end of the year. So we haven't been told whether it was actually paid. It will be accrued by the end of the year. So that is 500,000. Then we have in this case what? Creditors. So we have in this case creditors. So we are told as at 31st of December 2018, that is not number 5. Creditors of medicines and consumables amounted to 1.5 million. Creditors. There was an amount of 1.5 million. And of course, those are the items of what? Capital and liabilities. Those are the items of capital and liabilities. So you can be able to add these ones, add the assets and give me the figure here. Add the assets and give me the figure here. Another friend of ours can be able to add also what? The capital and liabilities. Another friend of ours can also be able to add the capital and liabilities. Capital and liabilities. So hope you've seen where we've been able to get these creditors. Hope you've seen where we've been able to get these creditors. I can see you're saying a figure of 14,140. 14,410. So 14,410. So 14,410. 14,410. 14,410. 14,410. So Nekesa, have you seen where we've gotten this figure of 1.5 million of creditors? Have you seen where we've gotten the figure? So I can see Daniel says capital and liabilities. Nekesa, have you seen where we've gotten this figure of creditors? This one, 1.5 million. So I can see you're saying yes, you've been able to see. It is actually under additional information number 5. So creditors for medicines and consumables amounted to 1.5 million. 1.5 what? Million. while 100,000 worth of medicine was still in stock. So this is now, in this case, what we've been able to recognize here, the closing inventory. So this one is as per note number, exactly as per note number 5. See the same case, this one is as per note. You know, if you want not to forget, you can indicate this so that when you'll be revising, you don't have to start having to ask yourself, where did we get this 100? You can basically put in bracket N5 so that when you'll be revising at your personal level, you'll be able to know where this figure was coming from, where this figure was having to come from. So of course, that is why in this case, you can actually be able to account for medical practice, but it has never been tested in the exam. So I don't know whether they'll be able to test this time. So what is the chance they can test? What is the chance they can test? In fact, the other lecturers don't teach it. They don't teach it. They don't teach it. So they don't teach it. But that's how you can be able to prepare them. So now in this case, I want us, we look at another area still under the same chapter. So another area under the same chapter, chapter number 3. I want us to look at, in this case, retirement benefits, or what we refer to as what? Pension plans. Retirement benefits, or what we refer to as what? Pension plans. So you can be able to write that. So International Accounting Standard number 26. So IAS 26. IAS 26, accounting for retirement benefit plans. 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 So ideally, what you're going to look at in a nutshell, so without having to go into a lot of hula baloo here and there, what is going to happen here in this particular area, you know, there are those firms that actually, in this case, collect contributions for pension. So they can, for example, in this case, be insurance firms, or in this case, we can have like employers who have established schemes whereby employees do what? Make their contributions. So they make their contributions so that when they retire, they'll be able to get their money. And of course, in this case, they normally get their money, which has earned some kind of, like in this case, what? Interest. So for example, in this case, an insurance company could end up having to approach you that in this case, maybe you contribute to a private pension scheme, that one in this case that is not actually maybe provided by the employer. So they tell you that in this case, you can actually be contributing maybe 10,000 per month. In this case, by the end of it, that is how much? 120,000. 120,000. For, let's say, for example, for the next 20 years, that comes to around 2.4 million. But at the end, you won't be able to get this money. They'll actually inform you, actually, you'll be contributing as the money earns what? Interest. So you're likely in this case maybe to fetch maybe 3 million. Or maybe you're likely in this case to do what? To fetch maybe 3.5 million, depending upon what? The terms. So there are a lot of activities that will end up having to happen regarding these monies of what? Of the pensioners. So basically, in this case, those who are contributing. So they, for example, get these monies. This interest doesn't, for example, in this case, just arise by itself, but they actually do what we call what? Investments. Maybe in this case, in government bonds or in securities that are earning what? Benefits. So that in this case, when these persons end up having to draw their money when they retire, they would be able to get their money at what? At some kind of, like in this case, what? Interest. So there'll be a number of activities having to occur. Members having to contribute as pensioners to the scheme. This firm itself having to do strategic investments to generate maybe income, so that in this case, that income can end up having to be redistributed to what? In this case, the redistributed in this case to the pensioners when they end up having to do what? Retire. So to have like a proper accounting as to what is actually having to occur, then there has to be, in this case, what? A maintenance of like a statement indicating what are the incomes. There has to be a maintenance of like, in this case, what? A statement indicating what are the assets. What are the assets that in this case, this insurance firm, this pension firm, or basically in this case, the firm providing a pension scheme is having to, for example, maintain as what? As assets. So that in this case, in any case, maybe it is liquidated, we can be able to know. Maybe you can be able to liquidate those assets. Then we end up having to do what? Get the monies for these persons who are doing what? Contributing. And therefore, the essence of having to do what? Account for pension schemes, account for retirement benefits, or pension what? Schemes, pension schemes. So you can be able to write something briefly. Before now, in this case, we start looking at what are the accounts to be maintained. What are the accounts to be maintained? Accounts to be maintained by pension scheme firms. So in this case, you can be able to write and say, IAS 26, this particular standard here, IAS 26, provide guidelines. IAS 26 provides guidelines for financial reports, provides guidelines for financial reports to be maintained for a retirement benefit plan, for a retirement benefit plan. Retirement benefit plan. So in this case, there's that term. So there's that term, retirement benefit plan. You can be able to say definition of retirement benefit plan. What is it? Definition of retirement benefit plan. What is it? What is this retirement benefit plan to be accounted for? You can be able to write this about a retirement benefit plan. It is an arrangement by which an entity provides benefits. It is an arrangement by which an entity provides benefits to employees after they are terminated from service. To employees after they are terminated from service. After they are terminated from service. After they are terminated from service. So that is that kind of an arrangement whereby you agree with the pension scheme firm that in this case you'll be paid when you retire, or in this case when your services are terminated. So by which an entity provides benefits to employees after they terminate from service. So you can be able to write in this case briefly, types of retirement benefit plans. 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 So types of retirement benefit plans. Types of retirement benefit plans. So you can write number one, defined contribution plan. Defined contribution plan. Defined contribution plan. Then you write this about a defined contribution plan. What is it? What is this defined contribution plan? Defined contribution plan. So these are plans under which the entity pays. These are plans under which I can see Missy says we can't hear. So kindly the others confirm. Am I audible? Can you be able to hear? Just say, I can hear, we can hear, so that Missy can be able to know whether, so I can see, we can hear, so you people can be able to hear. So I'm audible, I should be audible, Missy. So in this case, you're having to say, these are plans under which the entity pays, these are plans under which the entity pays fixed contributions, pays fixed contributions into, pays fixed contributions into a fund, into a fund, into a fund, into a fund. So these are plans under which the entity pays fixed contributions into a fund. And will have no legal, obligation, and will have no legal obligation to pay further contributions, and will have no legal obligation to pay further contributions into the fund, and will have no legal obligation to pay further contributions into the fund if it does not hold sufficient assets, if it does not hold sufficient assets to pay the employee benefits, if it does not hold sufficient assets to pay the employee benefits, to pay the employee benefits. Then in this case, you have what you refer to as what a defined benefit plan. So number 2, defined benefit plan. Defined benefit plan. So then you write and say, under this plan, under this plan, the entity has no obligation. The entity has no obligation. The entity has no obligation to provide. The entity has no obligation to provide agreed benefits, to current, and former employees. To current and former employees. To former employees. So the entity has no obligation to provide agreed benefits to current and former employees. Full stop. Then you write and say, the prevailing risk conditions, 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 will have to be considered, before, the benefits, are paid, The prevailing risk conditions will have to be assessed. You can go to say the prevailing risk conditions will have to be assessed before, you can be able to say will have to be assessed before the benefits are paid. The prevailing risk conditions will have to be assessed before the benefits are paid, So for this one, in this case, you're having to say that the benefits won't actually be, in this case, like be fixed. That these are how much, in this case, the employee will end up having to get. But by that point in time, they're having to pay, they'll have to consider any other, for example, actuarial risks. So actuarial scientists will be able to do the actuary computations or mathematics and say, for example, as per the prevailing conditions, market conditions, or any other condition, this is the amount that in this case you can be able to settle in terms of what? The pension at that point in time. So they'll be able to consider in this case what the risk factors prevailing. Before in this case, they pay the benefits to the employees. So that's what will likely end up having to happen under a defined benefit plan. Then in this case, under a defined contribution is whereby now in this case, an entity. So an entity will end up having to pay what? Fixed contributions into a separate fund or into a separate entity. This one is the most predominant one. So what they mean by, in this case, an entity, for example, an employer pays the funds into a separate entity or fund. Separate entity or fund. So let's say, for example, in this case, the employer is actually Safaricom. The employee is actually Safaricom. Then he actually ends up having to do what? Pay these amounts to Britam Pension Scheme. Britam Pension Fund. Britam Pension Fund on behalf of the employees. So what they do, they deduct the amounts and they put them into this particular pension fund. So the fund is actually maintained by what? By a separate entity. By a separate entity. By a separate entity. So they'll be able to do the assessment and actually be able to know whether this particular firm here, Britam, has adequate assets, has in this case adequate assets to safeguard or protect these funds that are having to be contributed on behalf of the employers. So they must be able to have adequate assets, because if the monies that they're having to get, maybe they put into assets. Let's say, for example, maybe in this case, securities or maybe shares that can be disposed of, then they eventually get monies that can, in this case, end up having to be paid to to the pensioners, who in this case are actually the employees. Who are the employees? So that is what will likely end up having to happen regarding the types. So we can now, in this case, look at the accounts. So financial statements for retirement benefit plans. So the financial statements for retirement benefit plans. The financial statements for retirement benefit plans. So the financial statements for retirement benefit plans. For retirement benefit plans. So they'll maintain two major types of financial statements. They'll maintain two major types of financial statements. So in this case, there's what we call statement of changes in net assets. So number one, we have the statement of changes in net assets. Changes in net assets. Statement of changes in net assets. Then number two, this one is like the income statement. This one will represent like what you know as an income statement. It will be able to represent what you know as income. This statement of changes in net assets. It will be able to represent what you obviously know as as income statement. Then we have in this case statement of net assets. So now this one is like the statement of financial position. So we have the statement of net assets. We have the statement of net assets. So this one is like the statement of financial position. This one is like the income statement of income. So it is for them under IS 26, we refer to it as a statement of changes in net assets. And for the statement of financial position, we refer to it as statement of net assets. So now in this case, how will these particular statements end up having to look like? So we can briefly, in this case, look at the format. The format before we look at an illustration. So before we look at an illustration, we can look at the format. The format, like for example, for these particular two statements, how will they look like? How will they look like? So the formats. So you can look at the format. So the format for statement of changes in net assets. So format, so you have the format. So statement of changes in net assets, statement of changes in net assets. Net assets, how will it look like? And what are some of the items that will end up having to appear there? So of course, you'll be able to indicate for the year ended. For the year, you'll be able to indicate for the year ended like that. So then in this case, of course, obviously, you'll be able to put that. You indicate your shillings, comfortably indicate your shillings. Indicate your shillings, whether in thousands or in millions, like that. Then most obviously in this one we've been able to say is like the income statement is equivalent to an income statement. Is equivalent in this case what an income statement or a profit and loss account. So you'll start in this case with the incomes that have actually been realized by the retirement under the retirement benefit plan. The incomes that have actually been realized under the retirement benefit plan. So the incomes here can include, for example, contributions. These contributions can be from members or employees, can be directly from employees or employers. It can be from employees or employers. So you can be able to put the amount there. That will still be part of the income to the pension plan. So contributions by employees or employers. So these are what the employees are contributing towards the pension scheme. So they'll be part of the incomes. They'll likely be part of the incomes. We can have investment incomes. Being able to say this money does not lie idle. They invest. So investment incomes realized. When they get the monies from the employees, they invest so that when they retire, they'll get their money with some kind of, like in this case, interest. So they can put in investments. For example, bonds. Then after 20 years, then they can be able to pay their They can actually be able to pay their pensioners. So in this case, we have investment income. They can put the money into rental properties, rental income. So they can have rental income. So that will still be part of the incomes. They can have, in this case, the revaluation gain on investments. Revaluation gain on investments. Revaluation gain on investments. This one is, for example, you buy shares at KQ for 10 shillings. Then they gain value up to, in this case, 50 shillings. So there's an increase here of 40 shillings. If you sell it at this particular point in time, you realize a gain. So that revaluation gain becomes like a profit. So they got the monies from the employees. They bought for them shares at 10 shillings. But now after 2 years, the shares of KQ have risen up to 50. They sell them at 50. They get what we call a capital gain. So that will be part of the incomes they can be able to realize. Gain on sale of investment property. Gain on sale of investment properties. Investment properties. So that gain or profit will be part of the incomes. And of course, that can basically end up having to summarize the incomes they can actually be able to do to realize. So that will become the total incomes. That will become the total incomes to the pension plan. The total income to the pension plan? To the pension plan. So I can see you're not able to see there. Yeah, I think that's okay. So those ones will be like, in this case, the incomes that can be generated in the pension plan or the retirement benefit plan. So, but now in this case, you can have expenses. So you just continue expenses. What will be part of the expenses they can end up having to incur? The expenses they can end up having to incur. So part of the expenses can actually, for example, in this case, include, so you can have less expenses. So we continue less expenses. Less expenses. So in this case, transfers to other schemes. To other schemes. transfers to other schemes. They can transfer these monies received to another scheme. So that will end up having to less the monies they have. It will be part of the expense. Benefits they might have paid to these persons who have already retired. Benefits paid. So it will be part of what? The expenses. So there's someone who has just retired in the current year, for the year ended 2025. In this current year, 2025, there are those who retired and they paid them. So their money was moving out. So that was an expense. So then they'll incur administration expenses. Remember, they have employees whom they have to pay to run these schemes. Administration expenses, like salaries to the employees under the pension plan. So rent expenses, maybe they have rented an office. So they'll incur the administrative expenses. So revaluation loss on investment property, So they can revalue a property and they realize a loss. Because in this case, we most obviously know properties which gain value is usually majorly what? Land. But if it's a motor vehicle, then maybe they got these contributions and they put in motor vehicles, like a matatu. So that matatu, when you revalue it, it would have lost value. So it would have lost value. But for land, it can gain, revaluation gain. So this land can come here, it will gain, because if you bought it at 10 million, after 3 years, 15 million, it will gain. But for a matatu, it will be a loss, which will be an expense. It will be a loss, which will likely be an expense. Or maybe they can sell an investment property and they realize a loss. So loss on sale of investment property. Loss on sale of investment property. So we'll end up having to be an expense. We'll likely end up having to be what? To be an expense. So all these ones, they'll end up having to be deducted. They'll likely be deducted. And of course, in this case, at the end of it all, you can end up having to get what we refer to as a surplus. Or in this case, what we refer to as a deficit. A surplus or a deficit. So we don't refer to it as a profit, because all these monies actually don't actually belong to, they actually belong to what? To the contributors. So they'll either in this case have like a surplus in the scheme or a deficit. So a deficit in this case, it means it's like a loss. It's like a loss. So it can be a surplus or it can be a deficit. So a surplus is like a profit. A deficit is like now what? A loss. But remember here, you're having to say, don't say profit. You say surplus or you say what? Deficit. So that's why in this case, how it will likely end up having to look like. It will end up having to look like. It will look like. So we can finalize by looking at the statement of changes in net assets. So I hope you've been able to copy this one. So you can look at the statement of changes, statement of net assets, statement of net assets. Because you've been able to say they maintain two types of accounts of financial statements. So you can now in this case look at the statement of net assets, not changes, but now statement of net assets. So you can look at the statement of net assets. You can look at the statement of net assets. Remember, this one is not for the year ended, but we say as at maybe 31st of December on a particular year. So this one is as at, is not actually for the year ended. So for the statement of changes in net assets, we say for the year ended. Or for income statements, we normally say for the year ended. But for balance sheet or statement of financial position, we say as at. Sawa. As at. Don't say for the year ended. It is as at. As at. So most obviously here we'll have the assets. We'll have the assets, which now in this case, we can have non-current assets. Non-current assets. because you'll have your shillings there. So the non-current assets in this case can include what? Investment in government securities, like bonds. They can get the monies for the pensioners and they put them in government bonds. Those will be assets. Investment in property, they can buy land so that it appreciates in value, then they'll sell it later. Investment property. Investment property. Investment in quoted shares. Investment in shares. Investment in quoted shares. Investment in quoted shares or investment in money market funds. Investments in money market funds. Money market funds, like that. Money market funds. Then you can have, in this case, what? Current assets. So this could actually be part of what the non-current assets, but you can have current assets. We can have current assets. So for the current assets here, we can have bank and cash balances. Bank and cash balances. Bank and cash balances. We can have, in this case, contributions due from members. Members who are yet to contribute, this amount are outstanding from them. Contributions due. We can have receivables or any other debtors. Receivables or any other debtors. And then, of course, that should be able to give you now, in this case, what? The total assets. Should be able to give you the total what? Assets. Total assets. Then in this case, you can actually be able to go to the other side. The other side, in this case, this will be the end of the side of the assets. And of course, we go to the side of this other side. We don't have capital, but we refer to it as accumulated fund. The capital here will be the accumulated fund of the monies that are having to be contributed. That fund becomes, like in this case, what? The capital. So we refer to it as what? The accumulated fund. Then you add the surplus. You got in the statement of changes in net assets, surplus or deficit. It will depend. So if you get a surplus, you'll add. If it is a deficit, you'll less. From the, this now, like now, you know, in this case, in the normal statement of financial position, this one will refer to it as capital, but here we don't have capital. The capital here will be now, in this case, what will be the accumulated fund. You know, now in this case, there's a fund which has actually been created for the pension plan, where the employees put their money. So they put their money. So that accumulated fund becomes like the capital of this plan. So that is what we'll be able to get to put here as what? As the accumulated fund, not the capital, but the accumulated fund. Then the surplus you got in the statement of changes in net assets, you put it here. Or if it's a deficit, which is like a loss, you'll now in this case do what? Deduct it. So then in this case, you can be able to have any other liabilities. So you can have, in this case, maybe the current liabilities. Current liabilities. You can have the current liabilities, which now in this case can include, for example, benefits due. Benefits due. Remember here we have what? Contributions due as a current assets. But now here we have benefits due. These are the ones they are yet to pay. So there are benefits which are supposed to have been settled already, but they are yet to pay. So it becomes a liability to them because they'll still actually be called upon to pay in future. So in this case, accrued expenses. Accrued expenses. Accrued expenses. Accrued expenses. So those will be part of what, in this case, what? The liabilities. And of course, that will actually mark the end of what? Maybe your statement of net assets. Statement of net assets. So that's how you basically present accounting for retirement of what? Of benefit plans. So we'll be able to do the illustration tomorrow, which I've already been able to share. I can see you are giving others investment in money market funds. So what is MMF? That is money market funds. Sawa. Money market funds. You can write it in full. Money market funds. Money market funds, they are provided all over by insurance companies. They tell you when you put in your money, it will gain interest. So they can get these monies for the employees that they have contributed into the fund. Then they put in money market funds so that it can be able to gain interest. When they be paying the benefits, they can pay at least these benefits with what? With an interest. Because that is what they have been able to give them as what? As an assurance. As what? As an assurance. As an assurance. As an assurance. This one is investment in quoted shares. Investment in quoted shares. Or you can just be able to say investment in shares, because you can be able to have quoted and unquoted. Just say investment in shares. You can just say, be able to say investment in shares. When they talk about quoted shares, they are those shares for quoted companies or listed companies on the securities exchange. But you can still, in this case, you can be able to have investment in shares which are not being listed on the securities exchange. It's still an investment. Still an investment. So you can just say investment in shares. Investment in shares. So that's why in this case, you present the statement of changes in net assets, which is like an income statement for the pension plan. And in this case, a statement of net assets, which is like in this case, what? A statement of financial position for what? For the retirement benefit plan. We will look at an illustration which I've already been able to share tomorrow. We'll look at it tomorrow. So this one is not complicated. It is very, very simple. This one is very simple. Very simple. It is very simple, and very direct. It doesn't have a lot of issues and stories. A lot of issues and stories, but it hasn't been tested for a very long time. But it's still part of the syllabus. We have no option. We have to teach it. So we'll be able to look at that illustration tomorrow. That illustration tomorrow. That illustration tomorrow. So after pension plans, I think in this case, the next thing we'll start looking at, under still the same area, I think I can be able to see conversion of a partnership into a company. So we would have tackled professional firms, agricultural activities, pension plans, cooperatives. So after, in this case, retirement benefit plans tomorrow, we'll start looking at conversion of a partnership into a company. And of course, that area will be done and dusted. That area will be done and dusted. It will be done and dusted. Then maybe in this case, we can maybe look at, we'll maybe in this case look at public sector. Then we'll be, after public sector, we'll be able to look at published. So published financial statements, that one is very crucial. That one is very crucial. That one you can't afford to miss the class. Very important. Very important. Very important. So I'll be able to reshare the illustration. You don't have to worry. Otherwise, thank you very much. You can have a good night. So let's catch up tomorrow. We look at an illustration on retirement benefits. Then we start looking at conversion of a partnership. So conversion of a partnership into what? Into a company. Conversion of a partnership into a company. Into a company is also another area you have to be very keen. The competitions are a bit, if you're not very keen, you might not actually be able to get what is happening. So you need to be very keen about conversion, because if it comes in the exam, it might end up having to look like a bit complicated. So you need to be in class for that one. Don't miss out on conversion of a partnership into a company. So there are very interesting double entries to be made there, which you must actually be able to understand. As why in this case, a partnership can be converted into being what? A company. Sawa. So have a good night and let's catch up tomorrow.